Hello and welcome everyone to Dezan Shira Associates webinar on an introduction to transfer pricing in China. So before we start, I just want to make sure that everyone can hear me properly. So if you could click on the interact button and then on raise hand if you can hear me properly. I also want to let you know that we will be having a short Q&A session at the end of the webinar. So if you have any questions or any comments throughout the webinar, please don't hesitate to enter them into the text box on the left-hand side of your screen. So my name is Aoife Hall. I'm working in the marketing department of Dezan Shira Associates, and I'm here today with my colleague, Shirley Chu, manager of our transfer pricing services. So I'll start by giving an introduction to our company. So Dezan Shira Associates is a foreign direct investment consulting firm set up in 1992 and specializes in tax, accounting, and legal professional services. It has offices throughout Asia, in India, Vietnam, and across China, as well as liaison offices in the US and in Italy. So to start off with Shirley, for those of us who have no background to transfer pricing, can you summarize the concept in just a couple of sentences?
Okay, thank you, Aoife. It is necessary for companies to put a price tag on properties, services, intangibles, or other types of transactions for trading purposes. Putting a price on the dealings between associated companies is called transfer pricing. Transfer pricing itself refers to pricing for transactions incurred between related parties.
So is transfer pricing a relatively new idea then? How did it become about?
Well, my understanding is that early on in the 20th century, as FDI from the US and UK rapidly expanded, some companies began to use transfer pricing as a method of tax avoidance through transactions with related parties. Understandably, this phenomenon was brought to the attention of national governments. Transfer pricing has maybe 100 years of history. However, the key points to remember regarding early transfer pricing were: first, the concept developed slowly. Second, most countries held a relatively tolerant attitude to the phenomenon. In the middle 1980s, the global economy entered a new era. The introduction of the computer and new communication technology accelerated the pace of globalization. As a result, multinational business groups developed rapidly, establishing branch offices and subsidiaries across the globe. MNCs utilized the transfer pricing as an effective way to shift the profits, and relevant nations saw a significant erosion in their tax base. This became an international issue that could not be ignored.
So Shirley, what is the transfer pricing environment like now? Have any regulations come into effect recently that you think are worth noting?
As previously mentioned, the middle 1980s saw the start of a new era of globalization that called for the evolution of transfer pricing regulations. There was this global consensus that we needed tighter legislation and strengthening of transfer pricing administrative practices. Transfer pricing related legislation is constantly being updated. In recent years, with the introduction of the BEPS action plan by G20 and OECD countries, transfer pricing has entered into a new stage of development.
So Shirley, what exactly is BEPS?
BEPS stands for Base Erosion and Profit Shifting. It refers to taking advantage of loopholes and gaps in tax regulations to shift the profits to an alternate location to achieve tax avoidance, double non-taxation, or long-term deferral. Its increasing significance on the international stage has made it one of the hottest taxation topics in the world today. As countries become more and more economically interconnected, base erosion and profit shifting has become increasingly severe, drawing attention from global political leaders and the public alike. In June 2012, the G20 finance minister and the central bank governor meeting reached agreement to address BEPS through international cooperation and appointed OECD to conduct relevant studies and research. Following the release of the report entitled Addressing Base Erosion and Profit Shifting, the OECD and G20 countries adopted a 15-point action plan to address BEPS in September 2013.
So Shirley, what exactly is the BEPS action plan? How does it relate to transfer pricing?
Following the release of the report addressing base erosion and profit shifting in February 2013, the OECD and G20 countries adopted a 15-point action plan. The action plan identified 15 actions along 3 key pillars. First one, introducing coherence in the domestic rules that affect the cross-border activities. Second, reinforcing substance requirements in the existing international standards. Third, improving transparency as well as certainty. After 2 years of work, OECD finally released the 15 points in October of 2015.
So back to transfer pricing. Can you talk a little bit about how it works, Shirley?
What refers to the pricing between related parties within a group. Independent companies will take different factors into account when pricing, but most of these factors relate to market behavior. That's why we call it fair market value. However, for intercompany transactions incurred between related parties, their relationship will often take precedence, which may sometimes include a taxation avoidance consideration. This is a very basic example illustrating how transfer pricing works. As you may see from the chart, the transactions look alike between each other. The difference is that the chart in the right side is an independent transaction, while the chart in the left side is a related party transaction. You may see that the legal entity A and the legal entity B purchase the products from a third party at the same price. But the selling price to a related party can be artificially high or low compared to a fair market price incurred between independent companies. Where the selling price is higher than 215, more profit will be retained in China, while the selling price is lower than 215, more profit will be shifting to the outbound related party.
So Shirley, can you talk about some of the different methods that are used in transfer pricing?
Currently, in the field of transfer pricing, there are 5 major methodologies, which are the comparable and controlled method, the resale method, the cost plus method, the transactional net margin method, and the profit split method. The former 3 methodologies are jointly known as the traditional method, while the later 2 methods are known as the transactional profit method. Additionally, there are other methods that follow a non-arm's length approach, such as global formulary apportionment and the valuation techniques. First, the COP method compares the price charged for property or services transferred in a controlled transaction to the price charged for property or services transferred in a comparable and controlled transaction in comparable circumstances. If there is any difference between the 2 prices, this may indicate that the conditions of the commercial and financial relations of the associated enterprise are not arm's length, and that the price in the uncomparable transactions may need to be substituted for the price in the controlled transaction. When it is possible to locate comparable and controlled transactions, the COP method is the most direct and reliable way to apply the arm's length principle. Consequently, in such cases, the COP method is preferable over all other methods. However, in reality, it may be difficult to find a transaction between independent enterprises that is similar enough to a controlled transaction such that no differences have a material effect on price. In terms of the resale price method, the resale price method begins with the price at which a product that has been purchased from an associated enterprise is resold to an independent enterprise. This price is then reduced to a proper gross margin on this price, representing the amount out of which the reseller will seek to cover its selling and other operating expenses, and in light of the function performed, make an appropriate profit. What is left after subtracting the gross margin can be regarded as just the adjustment for other costs associated with the purchase of the product, as an arm's length price for the original transfer of property between the associated enterprise. This method is probably most useful where it is applied to marketing operations. The cost-plus method begins with the cost incurred by the supplier of property in a controlled transaction for property transferred or services provided to an associated purchaser. Appropriate cost-plus markup is then added to this cost to make an appropriate profit in light of the functions performed and the market conditions. What is arrived at after adding the cost-plus markup to the above cost may be regarded as an arm's length price of the original controlled transaction. This method probably is most useful where semi-finished goods are sold between associated parties, where associated parties have concluded joint facility agreements or long-term buy and supply arrangements, or where the controlled transaction is the provision of the services. The transactional net margin method examines net profit relative to an appropriate base that the taxpayer realizes from a controlled transaction. Thus, a transactional net margin method operates in a manner similar to the cost-plus and resale price method. This similarity means that in order to be applied reliable, the transactional net margin method must be applied in a manner consistent with the manner in which the resale price or cost-plus method is applied. This means in particular that the net profit indicator of the taxpayer from the controlled transaction should ideally be established by reference to the net profit indicator that the same taxpayer earns in comparable uncontrolled transactions. When this is not possible, the net margin that would have been earned in comparable transactions by an independent enterprise may serve as a guide. A functional analysis of the controlled and uncontrolled transaction is required to determine whether the transactions are comparable and what adjustments may be necessary to obtain reliable results. The transactional profit split method seeks to eliminate the effect on profits of special conditions made or imposed in a controlled transaction by determining the division of profit that independent enterprises would have expected to realize from engaging in the transactions or transactions. The transactional profit split method first identifies the profits to be split for the associated enterprises that are engaged. In addition to the 5 transfer pricing methods mentioned above, there are also other non-arm's length approaches like global formulary apportionment and valuation techniques, which is applied for some special cases.
Thank you, Shirley. So to give us a bit of a better understanding of the subject of transfer pricing, can you maybe walk us through a typical case that you have done?
Yes. In our day-to-day experiences with transfer pricing, our most frequent cases involve helping foreign multinational companies who are planning to invest or have already invested a manufacturer, service company, or trading company in China to establish a transfer price for a transaction or review their transfer pricing documentation. For example, I'll give you one case that I dealt with several months ago. My client was a multinational company which is engaged in online sale of customer-made leather products. The shoppers may choose the shape, color, and other features of the leather products and make orders online. The China-located entity is responsible for producing the products based on the online order. The final products are distributed to the end users through either a physical store located in North America or by courier directly posted from China manufacturer. Through a quantitative analysis of the functions performed by the company, we help the client to establish the arm's length price and prepare necessary supporting documents.
China's transfer pricing legislation started fairly late compared to countries like the US, UK, and Japan. However, in the last 10 years, China's transfer pricing legislation has entered a period of rapid development. As a result, China's transfer pricing regulations have been very successful.
Firstly, for related party transaction reporting and TPD, it introduced the concept of the master file and local file, which are addressed in the BEPS action plan and the country-by-country report for the annual related party transaction reporting, and set for certain thresholds in accordance to China's actual situation. Secondly, the Chinese Tax Authority recently released a new rule which revised and updated the existing APA rule. Additionally, in early 2015, China also released a new provision regarding intra-group outbound payments. This shows that China's tax authority will gradually increase The implementation of tax policies meant to reduce tax base erosion through outbound service fee and royalty payments.
So to continue on, Shirley, can you talk about some of the documents which are relating to transfer pricing, which have been submitted by companies doing business in China?
Currently in China, there are two major types of documentation relating to transfer pricing issues that should be prepared for submission to the tax authority. One is the annual related party transaction reporting form, which should be submitted to tax authority at year-end tax filing. Currently, the annual related party transaction reporting documentation is made up of 9 forms. However, beginning in 2017, which is applicable for the 2016 fiscal year, a new set of more complicated forms will be introduced by the tax administration. Included in these new forms is the country-by-country report, which was developed as a part of BAPA's action plan. Another type of document that should be proactively prepared by taxpayers is the TPD. As with the annual related party reporting forms, starting from 2017, which actually covers the 2016 fiscal year, the TPD preparation should follow the new transfer pricing rule. The new rule introduces the concept of the master file and the local file, the concept which is also developed in BAPA's action plan.
So Shirley, do you have any tips for preparing transfer pricing documentation?
As mentioned, starting in 2017, a brand new TPD rule will be implemented. This is not only a rule for the taxpayer, but also for the tax authority. It firstly requires taxpayers to judge whether or not they will be subject to the obligations under the new rule. If they find they are in fact obligated to fulfill them, then it is important for the company involved to get to work on the documentation as soon as possible. Last-minute correspondence should be avoided. In addition, TPD preparation is absolutely essential for compliance, and all content should be disclosed in the TPD. Actually, I would recommend that the taxpayer find a more experienced firm to deal with this, and they will have sufficient experience to identify potential transfer pricing issues and would be able to provide advisory as well.
So we've talked a lot about transfer pricing for tangibles, but what about transfer pricing for intangibles, such as trademarks or even services? How does that work?
As with tangible goods transactions, intercompany intangible transactions must also comply with the arm's length principle. However, unlike tangible transactions, each intangible transaction is unique, which can make it difficult to find a comparable transaction. To deal with this pricing issue, we look to special approaches such as the valuation technique. As a matter of fact, intangible-related transfer pricing issues have started to draw more attention from the tax authority. Still, we need to recognize that intangible-related TP legislation are still a work in progress. In reality, a lack of practical guidance concerning TP is also a problem. However, early on in 2015, China's tax authority released a new rule pertaining to tax-based erosion brought about by intergroup outbound service payments and royalty payments. At the moment, China's practice is that when a taxpayer wants to make an outbound payment, they need to file and record the intercompany service or licensing agreement with the relevant tax authorities before making the payment. The tax authorities will only conduct a pro forma review on the agreement itself. It is unlikely for the taxpayer to be challenged by the tax authority at this stage of the payment. However, with the impact of BAP's action plan and the recent global attention on intangibles, tax authorities are paying increasing attention to this issue by a substance over form principle, which follows aligning the transfer pricing outcomes with valuation creation concept raised in the BAP's action plan.
So Shirley, I know that you handle transfer pricing issues every day. So what are some of the most common questions that you're faced with?
In our day-to-day experiences with transfer pricing clients, one of the most frequently asked questions we get are, what is China's TP policy? What do we need to do to comply? In response to these questions, we usually tell our clients the most recent TP rules and help them to understand those indirectly relating to their situation. In addition, we usually advise our clients to pre-check the transfer price and ensure that it complies with arm's length principle. They should also read up on China's transfer pricing laws, prepare relevant documentation, and make any necessary revision or adjustment in advance to avoid any potential headache in the future. Another recurring issue that we see among our clients is that because they may not fully understand China's TP regulations, many clients are not sure how to go about reviewing their TP documentation. TP documentation is necessary for compliance, which means that as long as the transaction amount lies above the threshold, you should have it prepared for submission upon the tax authority's request. However, this does not mean that the company whose transaction amount lies below the threshold will be 100% safe and should disregard TP issues. Although you don't necessarily have to prepare the documentation, unreasonable TP such as outbound payments still run the risk of being audited or adjusted in the future. Another topic that we are frequently asked questions about is outbound payments. Many multinational business groups set up entities in China. Many of them think that because they are providing some manner of assistance to the local entity regarding finance, human resource, IT, or marketing, the local entity should follow a certain arrangement or by certain means, such as a management fee, service fee, or royalty to bear the cost. According to our experiences, however, most of these charges or arrangements are not reasonable and are without basis. Even if there is some basis for it, it may not apply to transfer pricing transactions. The legislation relevant to the circumstances are still being developed in China. However, from the tax authorities' practice, such as publicly opened audit cases, I believe experienced accountants will know where the exposures are and how to mitigate the risks.
Thank you very much, Shirley, for your comprehensive overview of transfer pricing. I'm afraid that's all we've got time for today, but we would like to address some of the questions which have been coming in from the participants. So our first question is from Dana in Germany. So, is transfer pricing limited to a certain type of entity?
When we talk about transfer pricing, it refers to the transaction incurred between related parties. And from the Chinese, the PRC transfer pricing regulation perspective, I think the tax authority will focus more on the cross-border transactions, which may, cause a potential profit shifting or base erosion kind of issues.
So Shirley, for example, for someone who has no knowledge at all of transfer pricing, is it possible to transfer to a representative office, which is a related company?
Yes, basically it is limited to a specific type of enterprise. It is only applicable to enterprises who are involved in profit-making activities. Actually, according to PRC law, RO is not allowed to participate in profit-making activities. Besides, in China, ROs use a different way to calculate the profit and tax rate.
So Shirley, Mike is asking that he's saying that sometimes they receive as a company expenses from foreign companies, but is there a way of proving this with the Chinese tax authorities?
As mentioned in the presentation, the overseas headquarters in China subsidiaries may have various intercompany charges. In some cases, the overseas headquarters may want the subsidiary to undertake the relevant costs. It really depends on the nature of the charge. Basically, in this case, the tax authority would often look for further information.
Thank you, Shirley. So I have another question, which has just come in from Margaret. So her question is that her company is just a startup company. So after 6 months, they found out the transfer pricing from the head office is too high. So is it possible to do a one-time deduction? So for example, a 40% decrease?
Well, to answer this question properly, I think I would need some further information. You mentioned that the TP is too high. Why do you think it is too high? Is there any benchmark study which leads to this conclusion? Basically, if a taxpayer found that the TP is unreasonable through a self-check, we would encourage them to make some price adjustment to ensure that it is compliant. I think maybe it is better to make price adjustment gradually so that you do not attract too much attention and the tax authority find that last year you were not compliant.
So Shirley, what are some of the main challenges in the future for transfer pricing in China?
I think just as mentioned during 10 years of development of China, the PRC's TP regulations, China tax authority tends to be more experienced than 10 years ago. And another phenomenon is that China, since China is actively participate in the or global or international actions such as the BEPS action plan. So the China tax authority is trying to convert the international rule into the domestic law. So I think in the future, in the coming years, the China TP law will be more severe for especially for the significant amount cross-border transactions. So I think the taxpayers need to pay some attention to the transfer pricing issue when doing business in China.
Shirley, we have another question from Jerusalem this time. So they're asking, is it possible to mitigate risk when transferring management fees?
Well, talking about management fee, this is actually quite often frequently asked the question by our clients. I think for our clients, there is a misunderstanding about the management fee. Here, the management fee we talk in China is refers to a stewardship nature of expenses. According to China tax law, the management fee cannot be deducted when computing corporate income tax. So for some of our clients, since their headquarters in outbound China, so they are trying to charge some management nature of service fee to the local entity by management fee. But we should remind you that if you prepare such a management fee contract, then all the items listed under that agreement cannot be deducted when computing corporate income tax for the local entity. So we suggest to use a service fee rather than a management fee for such kind of transactions.
Shirley, I have another question which has come in from Hong Kong. So there's asking what the authorities are looking for in the royalties agreement. So for example, in the case of a trademark license agreement between a foreign company and a subsidiary in China. Can you talk more about maybe how that would work?
Okay, just as mentioned in the presentation, intangible transaction is sort of a special area still under development in China. We are in a situation where it's a lacking of practical guidance from tax authority on how to deal with the intangible transactions between related parties. But still, I think in practice we can use some special database, which is especially for royalty, to make a arm's length or proper rate pricing mechanism for the royalty charge between the related parties.
So we have a question, Shirley, this time from Hanoi in Vietnam. So they're asking about preparing TPD as a compulsory document for transfer pricing. So what exactly is the threshold and the rules behind this?
Under the current TP law in China, we have thresholds for physical goods and for other types of intercompany transactions. But as just mentioned in the presentation, starting from next year, which is actually applicable for the 2016 fiscal year, we are start to using the new TPD rule and as well as new thresholds. For your reference, for the physical goods is still like 200 million and for the local file, but actually it's more much more detailed than the old rule. Maybe we can share this later with you, the exact data.
Yes, exactly. We will include a contact email for Shirley at the end of the presentation. And so if you have any further questions on the questions that you've submitted in the question panel, we would be more than happy to answer these. So to continue on with some of the questions, we still have some minutes remaining for the webinar. So this time we have one from Hong Kong, and they're asking if SAT has internal guidelines on markups for cost plus transfer pricing. If you know anything about those guidelines, Shirley.
As far as I know, China SAT does not have any internal guideline for how much percent of markup you need to apply for under the cost plus method. I think we don't know that.
And so we have another question from Italy. So this one is, what is the main differences between country by country report and the local file?
Well, there are several new rules which are developed in BAPA's action plan. China Tax Authority is trying to convert this international rule into domestic law. There, as mentioned in the presentation, there are several documentation requirements here in China. For TP documentation, it's actually stand for transfer pricing contemporaneous documentation. It's like almost 100 pages of a report which you need to get prepared once you hit the threshold. For that report, under the new rule, there are two types of report. One is a master file report, and the other is the local file report. For the master file report, basically there are more stricter requirements for the taxpayers, which means that you need to hit the higher threshold. So you have to prepare that report. But for local file, basically, as long as your annual related party transaction amount exceeds, like for physical goods, for example, like 200 million, you have to prepare the local file. For country by country report, it's according to the China tax law, you need to prepare this report or submit along with the annual related party transaction reporting forms. That should be done by the end of tax filing activities. So basically, these are two type of compliance obligations.
So we have another question, Shirley, this time from Luxembourg. And so they're talking about, they have two subsidiaries. So they have one in Hong Kong and the other one in China. And the Hong Kong one is set up with rights to market the parent company's products in China. So is there any issues that they should pay attention to, for example, with the trade contract between the two subsidiaries regarding TP? Can you talk maybe about two subsidiaries, so one in Hong Kong and the other in China, on how this might affect TP?
Okay, so here I think in the question, it doesn't mention what the nature of the China entity, right? Nature, it's a trading company or it's a manufacturer?
Maybe Shirley, if you can talk a bit about how this would affect a trading company firstly, and then maybe we could move on to a manufacturing company, just in brief for everyone.
Okay, I think for nature of the company, basically, if you are the transactions is incurred between related parties, still you need to pay attention to pricing mechanism or the pricing method they used, because basically depending on the transaction amount, the tax authority's attention will be different. But if you can, to to make this well prepared in advance, then it can largely mitigate your future risk in terms of transfer pricing.
Thank you very much, Shirley, for your response. So we have another question from Jerusalem. So this one is, do we need a service fee agreement between headquarters and between the Chinese subsidiary?
I think if the China entity and the headquarters do have some service transactions, definitely you need a service agreement. I think, as mentioned, China Tax Authority start to pay attention on this kind of issues with the substance over form principle, which means they will look into more the substance of the transaction, if it's real or not, it's artificial or not. So if you do have the transactions, obviously you need to prepare the service agreement.
So Shirley, I have another question. So you talked during the webinar about a specific case regarding transfer pricing for tangibles. So what about a case that you were involved with? Maybe you have some tips for transfer pricing regarding intangibles, so for maybe trademarks or services.
I think I can share with you a case that we did in last year. We have a client which is trying to, they are actually trying to shift some profit, not shift to repatriate the profit, extra profit to out of China. They are seeking some right way to do this. So they come to us for these questions. So we have to analyze their actual situation. We look into the service transaction, the royalty transaction, and then we found that actually this company is using the trademark which is licensed by the outbound headquarters, but they are not charging any royalties for this transaction. So we have this client to do some analysis on that. So have the clients to set up the licensing agreement in terms of the trademark which is used by the local entity. Yeah, so basically, I think in terms of intangible transactions, there are some debates for the taxpayers, the companies to think about it for some profit repatriation purpose or something like that.
So Shirley, we have another question coming in from Hanoi this time. So say, for example, if someone finds out that their transfer pricing is not arm's length, that it's impossible to use the arm's length method, is there any possibility that you can use, do some actions like, for example, issuing a credit note or a debit note in this case?
I think it should not work. It doesn't work because transfer pricing is actually need to be done from the beginning when you set up these transactions. The transfer pricing issue is about the price you are used. It's different from the credit note or debit note. It's about the risk that you will be this issue will be observed or found out later by tax authorities. The transfer pricing related audit or adjustment, we call it a special tax adjustment in China. So it should be a totally different kind of issue when compared to the other tax issues.
So Shirley, we have another question coming in, and they're wondering if it's difficult to arrange an APA and how long it might take to sign one.
I'm sorry, I can't. I cannot know how long it's signed recently because we just have a revision our current APA rule like a few weeks ago. So it's true that in China, the taxpayers in most cases will need a very long time to get the APA signed. It's true, but it seems like tax authorities trying to change this kind of situation by under the new rule. I think probably maybe later we can share with you the new rule regarding the APA. in China?
So Shirley, we have another question coming in, and it's about an adjustment when using the TNMM, so creating an expense in China. So would this be company tax deductible? And would the profit adjustment create any additional tax or duties, which would not be deductible for either the Chinese or the foreign entity? I think for this question, I think we will reply later on to the submitter, and Shirley will reply directly for that question. So Shirley, just before we finish up today's webinar, do you have any final comments or maybe some suggestions for people whenever they're preparing their transfer pricing documentation that you would like to give?
Since the TP documentation rule is changing, I think the first thing I think that we will recommend to taxpayers to check out if you are obligated to such an obligation, the new rule. If you do, then start to prepare as soon as possible. Find the right consulting firm or consulting company to do this for you.
I'm afraid that's all that we've got time for today. I would like to thank everyone for attending this webinar and would like to apologize about the sound quality during this, and that of course, for everyone, the slides and the recording will be available for all of the attendees afterwards. So also, I would like to, if you look at this slide here, the final slide, you can feel free to contact Shirley Chu. Her email address is here for any specific questions that you may have in the future. And she would be more than willing to give you an overview of it, and more than happy to answer it. Also, if anyone has any further inquiries on the subject, or if they need any advice on doing business in China or in Asia, we would be more than willing to help you out. So thank you once again very much for listening to this webinar, and enjoy the rest of your day. Thank you.